Picture a single number. Every few weeks, a committee in a quiet Washington room decides whether to nudge it up, down, or leave it alone. They usually move it by just 1/4 of a percentage point. Yet months after that tiny adjustment, the price of groceries stops climbing, a construction crane goes completely still, and a foreign factory cancels orders. The part that should stop you cold is that this rate hike never touches a single consumer price tag. It doesn't mandate a cap on the cost of bread or gas or rent. Not one. To understand how moving one number pulls prices down, you have to look at what inflation actually is. It is simply too much aggregate demand chasing too few goods. When everyone wants to buy, and the economy can't produce fast enough to keep up, sellers raise prices because they can. The central bank can't fix the supply of physical goods, so it targets the demand. And it does this by setting the cost of money, the baseline interest rate that ripples outward into the rates everyone else charges. This single rate alteration initiates a deliberate, multi-channel chain reaction. It is designed to systematically throttle aggregate demand across the entire economy. Monetary policy is an engineering mechanism. The goal is to orchestrate a controlled economic slowdown so that you, your neighbor, and the big company across town spend a little less, systematically stripping sellers of the power to keep raising prices. When the central bank lifts its policy rate, borrowing costs cascade outward instantly. Mortgages and business loans get pricier, while the reward for saving improves. This triggers the investment channel. Because borrowing is punished, previously profitable business expansions suddenly do not pencil out. The company holds off, capital investment slows, and households run the same math on large purchases. They look at the heavier monthly payment, and they wait. You don't need a new loan to get caught in the engine. Welcome to the cash flow channel. For anyone carrying existing variable rate debt, their monthly repayment automatically adjusts upward when rates rise. Money meant for hiring or weekend trips now flows straight to the bank. Nobody purchased anything new, yet disposable income shrinks across millions of households and businesses simultaneously, dragging total consumer spending down with it. These first two channels act as direct extraction protocols. They drain capital out of the real economy, leaving fewer dollars available to chase goods. The third path is the wealth effect. When interest rates rise, the prices of assets like stocks and real estate tend to come under pressure. Higher rates make safe savings more attractive, while investors reprice equities and home values downward. Even without selling shares, this dipping net worth forces cautious spending. Furthermore, as asset values fall, the collateral people and businesses can borrow against drops with it. Their leverage evaporates. The fourth channel is the exchange rate. When your central bank raises rates and others don't, your assets pay a higher return. Foreign investors move money in to capture that yield. To do it, they buy your currency, heavily driving up its value. A stronger currency makes imported goods cheaper, directly pulling down the price of anything bought from abroad. Concurrently, it makes your exports more expensive for foreign buyers, cooling demand for your domestic factories. The final path targets the supply of credit. In a high-rate environment, commercial banks tighten underwriting standards. The physical pipeline of new credit constricts. Loans that would have been approved yesterday get rejected, regardless of the borrower's willingness to pay the higher rate. These peripheral channels compound the initial extraction. They create an inescapable, multi-front squeeze on aggregate demand, working through investment portfolios, across international trade, and fundamental access to credit. You'd expect this engine to work fast, but it operates with long and variable lags. Capital costs change instantly, but human behavior doesn't. A company cancels a factory months after rates go up. Shelving a housing search takes a year or more to execute. This setup creates a treacherous policy trap. Central bankers are steering a massive vessel where the wheel's input doesn't alter the trajectory until a year after it is turned. If they hike rates aggressively and inflation doesn't immediately budge, the temptation is to panic and slam rates even higher. But doing so risks tipping the economy into a severe recession that is already locked into the system long before the data shows the overshoot. There is a final, unquantifiable variable that dictates how smoothly this engine runs: public psychology. Inflation is partly a story people tell themselves about the future. If economic actors genuinely believe the central bank will do whatever it takes to crush inflation, they stop building rising prices into their business plans. They stop demanding preemptive wage hikes. The economy cools organically. But if the public doubts the central bank's resolve, that doubt gets baked into structural costs. Inflation digs in, forcing the central bank to deploy even harsher rate hikes just to break the cycle. The transmission engine is high friction. It is governed equally by mathematical lag and the psychological credibility of the institution operating it. Notice the careful phrasing here: demand-driven inflation. The policy rate has an absolute mathematical limit. It is a one-way valve that only throttles demand. Occasionally, prices rise because the global supply chain violently breaks. A war cuts off oil supplies, an embargo hits, or agricultural output completely collapses. Against a severe supply shock, rate hikes are mathematically incapable of resolving the issue. Making commercial loans more expensive cannot conjure oil out of the ground. It cannot magically unblock maritime ports or force wheat to grow. Policymakers are left with a grim choice. They can wait for physical supply to recover, or they can crush aggregate demand so severely that it matches the new, broken baseline of supply. This is why economists must meticulously diagnose the root cause of the inflation. They have to separate the hot demand they can fight from the broken supply they can't, before they ever touch the interest rate lever. The cost of money is a highly specific, blunt instrument. It is perfectly engineered to starve an economic fire of oxygen, but it is entirely useless for rebuilding the house. To see this theoretical network in practice, look at what happened after 2022. The central bank's actions served as the ultimate modern stress test of this transmission system. They executed one of the fastest tightening campaigns in modern history, lifting the policy rate by more than 5 full percentage points in roughly a year and a half. The macro result was the steepest demand-side disinflation recorded in over half a century. Empirical data points to a massive correction. Without the central bank's intervention, underlying inflation over that stretch would have run 3 full percentage points higher. That massive correction validates the multi-channel model. Broad economic cooling is achieved almost entirely by suppressing demand, without touching physical supply. The central bank never targets the price tags on the shelf. It exclusively targets the capacity of consumers and businesses to actually pay them. The next time you see a headline about interest rates changing, you will know exactly what is happening beneath the surface. The economy is governed by this invisible chain, deliberately engineering friction to ensure that, eventually, sellers lose the power to raise their prices.